Crypto for Dummies. Bitcoin, blockchain, cryptocurrency. When people are talking about these buzzwords, you can bet there is a wave of gains to be made. But all this talk can often lead to more questions than answers and too much hype. It's hard for someone who's never had exposure to cryptocurrency markets and technologies to tell what's real and what's not. Hi, and welcome back to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Cryptocurrencies are a hot topic, but what does this entail? So if you're a crypto newbie, you've landed on the one video that will turn you into a crypto expert. If you've heard about cryptocurrencies like Bitcoin, Litecoin, NFT'S, or Ethereum, and are wondering what the heck it is, this video is for you. I'll explain how it works and why it's becoming highly relevant. But before we start, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. Now let's get to the video proper. Money is a recent innovation that has only been widespread since the Middle Ages. We'll name this period Stage 1, when the only method to make a purchase was to approach a seller and say something like, "I want to buy your cow." To get it, you'll have to trade 3 goats. But money isn't really that important. It's actually a side effect of something far more interesting: currency. Currency allows us to have a thriving economy where we can give our money to someone else in exchange for a thing that they produce, and then we can use those things to exchange with others to get what we want. The second stage is coins. Because they were made of valuable materials such as gold and silver, everybody agreed that they were valuable. Take, for example, the British pound. They are named pounds because 1 pound is equivalent to 1 pound of silver, and when trading, it makes no difference if you don't want to purchase the cow as long as I have coins. Even if you have no use for the silver, we can still trade for your goats because it is a valuable commodity. You are reassured by the fact that you can take the coin, give it to somebody else, and exchange it for the product you really want. Then, when banks were founded and governments gained control, this progressed to Stage 3. We understood that we could get rid of the necessity to transport slabs of valuable metal in favor of something far more practical, as long as there was trust in the system. The same thing happens with paper money, but because it is composed of pure paper, the money no longer has any value. It only has value because the government says it does, much like a UK 10-pound note. But when technology advanced, humans discovered even more practical methods of storing and trading our possessions. When more individuals use credit cards to make online purchases, Stage 4 is attained and we can no longer see our money. It has nothing to do with notes, cows, or coins anymore, it's only spreadsheet entries. And now, we have arrived at Stage 5, cryptocurrency. Many consider it the most practical era in the history of exchange. A cryptocurrency is best understood as being entirely virtual. In essence, it is only the transfer of digital assets. There is no gold, silver, or even paper. Imagine them as nothing more than running spreadsheets that show who has paid whom and what. But with cryptocurrency, there is only one massive spreadsheet that lists every transaction done with that currency, which is referred to as a ledger. This is in contrast to various banks maintaining their own separate records. The reason why everyone is going crazy over cryptocurrencies is that there are certain advantages to a system of currency like this. One is that it's decentralized, meaning that while every transaction of a particular cryptocurrency is recorded within the same ledger, there are numerous copies of that ledger and everyone who is a member of that network has one. The terms Bitcoin mining or cryptocurrency mining may be familiar to you, but all it pertains to is an individual who has set up a computer to process transactions on their own copy of the ledger or spreadsheet. If you use your computer to mine a particular cryptocurrency, like Bitcoin, you can get some Bitcoin as payment. For instance, when you enter a shop and spend 5 Bitcoins on anything, the business runs the transaction by every computer in the network instead of merely verifying with one bank's records to see whether you have enough. In such case, each computer will separately update its records after receiving the go signal from the others. Therefore, because you end up with this many copies of the same ledger, detecting any suspicious activity is pretty simple. It won't work if you attempt to get into another person's networked computer and change the numbers on their copy of the ledger to give yourself more money. The system will notice that 99.9 of the copies on the ledger are saying one thing while one is saying another. Hence, it was probably tampered with. The system is well organized, and people trust it since they feel that open traceable transactions will be far more prevalent in the future than having different parts of the record scattered throughout. In addition, many places around the globe do not have access to traditional banks, which need a great deal of paperwork and documents, but they do have internet, which is all you would need for cryptocurrency. 2. Because everyone stores their information on this ledger, the primary advantage of cryptocurrency is that banks are no longer required. Without spending limitations, international payments can be made almost immediately instead of requiring a half day for the transaction to go through. Exchange rates, interest rates, and even transaction costs for certain cryptocurrencies are not a concern. Cryptocurrencies are called cryptocurrencies because cryptography is used to secure them. One example is blockchain, which is used by several leading cryptocurrencies including Bitcoin. But to clarify, blockchain is a secure kind of ledger, not Bitcoin or a currency in and of itself. Blockchain is only a method of organizing the massive spreadsheets that everybody uses to record transactions into blocks. So every time someone pays for something with Bitcoin, that transaction is recorded as a block. Each block includes a hash, which serves as a unique identifier, and transaction information such as who received payment and how much hash. The foundation of this system is that if something in a block is changed, the hash of that block will change, as will the hash of the previous block in the chain or the most recent transaction recorded. Since each block also carries the data from the previous block, if the block's hash changes, the following block won't have a matching hash and every block after that one will be invalid. If someone would want to illicitly create a transaction that, for instance, paid you money, that person would not only be required to tamper with the block as well as every block after it, but also do so on at least 500,000 computers worldwide. So the majority of computers in the system would also be consistent with the one tampered with. In contrast, it is possible to hack into somebody's dollar account and transfer money. In some instances, all it takes is to guess someone else's 6-digit PIN. However, there is a significant difference between that and simultaneously attempting to hack into 500,000 uncorrelated systems. Meanwhile, there are problems with cryptocurrencies. You've heard of individuals investing in cryptocurrencies, which means they are trading paper currency like dollars for cryptocurrency like Bitcoin. They believe that if cryptocurrencies catch on, their value will soar and they will be able to either use them or resell them for more money than they were initially purchased for. There is a phrase for cryptocurrencies that skyrockets. It is called mooning or going to the moon. But since each cryptocurrency has unique qualities, the only decision to be made at this point would be which one to choose. For instance, the second most popular cryptocurrency, Ethereum, can execute transactions even quicker than Bitcoin. There is also one that is said to be more advanced technologically called Cardano, and there is one with a newer algorithm called Litecoin. On the other hand, cryptocurrency is currently in quite a weird position, which brings up its disadvantages and negative side. First, because cryptocurrencies are new and entirely digital, many individuals do not take them seriously because of their volatility. Everyone speculates on the value of cryptocurrencies since no one truly understands how much they should be valued. They are influenced by the news cycle. For example, their prices soar when a positive story about them is published, but when Elon Musk criticizes them in a tweet, their prices plummet. Second, they aren't actually accepted as a method of payment. Well, you can donate to websites like Wikipedia using crypto, but numerous businesses have been hesitant about it. Examples of companies that first stated they would take Bitcoin before changing their minds include Microsoft, Tesla, and even Burger King. Third, there could be environmental issues. Many of these cryptos are highly secure since transactions are repeatedly verified by a large number of computers. That much computational power needs a lot of electricity. Still, depending on who you ask, someone might also argue that traditional banks consume higher electricity, that newer coins have advanced technologies and are far more efficient, and that eventually we'll be able to obtain that electricity from renewable sources. And lastly, fourth, since there is currently no actual regulation or policing of cryptocurrency, it serves as the ideal form of payment for criminals. Chain research shows that 0.34% of cryptocurrency transactions are criminal. Meanwhile, around 5% of regular cash transactions are criminal. However, there is a misunderstanding that cryptocurrencies like Bitcoin are anonymous. Cryptocurrencies are essentially pseudonymous, meaning that your public key or unique identifier will be permanently ingrained into the blockchain once you make transactions with it, even while your personal information is hidden from the public eye. Additionally, some purely bizarre things have developed as a result of crypto. For instance, you may be familiar with NFT or non-fungible token. Traditionally, when you want to buy a painting, you go to an art gallery and purchase the painting you like. But because of the blockchain, you can now pay to have digital ownership over anything, but others can continue to use or share it. All it means is that you would essentially be the original owner, and they would all be sharing copies of it even though duplicates appear to be almost identical. Many of these NFTs are simply JPEG pictures. Some individuals find this stupid and amusing because there is a clear distinction between purchasing an NFT and purchasing the rights to anything. You can produce merch or sell licenses if you buy the rights of a service, but not with an NFT. All reproduction rights for the item still belong to its first owner. You're just utilizing the blockchain to show you own some ownership stake in that item. Jack Dorsey, the CEO of Twitter, sold his first tweet as an NFT for $2.9 million. The buyer now effectively has some digital ownership over a JPEG image. And lastly, Dogecoin. Dogecoin was developed as a joke but is built on the same technology as Litecoin. Its value increased because people kept sharing it and investing a little money in it because they found it amusing. And as a result, there are now individuals who had become millionaires simply by purchasing Dogecoin when it was cheap. It sounds like we've reached the end of this video. If you found this video helpful, please hit like and subscribe, and comment down below with your thoughts about cryptocurrencies. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy.